Hi, I'm Tyler Miller, and I'm a wealth manager and tax specialist here at Raymond Gorell Wealth Management. Today, we're going to explore the benefits of net unrealized appreciation, or NUA treatment, within your company's 401k plan. Net unrealized appreciation is one of the most lucrative tax strategies available within the Internal Revenue Code. NUA allows certain individuals the ability to reduce the tax rate paid on a portion of their 401k assets. Most companies allow you to invest in a variety of different options within your 401k. These investment options typically include a selection of exchange-traded funds, or ETFs, mutual funds, target date funds, and some plans allow you to invest directly in their company stock. Net unrealized appreciation directly pertains to the company stock portion of your 401k investments. When withdrawals are made from a pre-tax account, these withdrawals are taxable at ordinary income rates. These rates can be as high as 37%, dependent on how much taxable income you have in that year. NUA treatment will actually cut down the amount of taxes owed on a traditional 401k withdrawal. Instead of paying ordinary income rates, NUA allows a portion of these funds to be taxed at capital gains rates, which are much more preferential. Let's look at an example to show how this works. Assume we have an individual named Jack. Let's say Jack has accumulated $500,000 of company stock within his 401k during his career. Jack's cost basis is just $50,000, which is what he paid for the stock in his 401k plan. With normal distribution rules, Jack would have to pay taxes on the $500,000 to get the funds out of his 401k. This could cost him upwards of $120,000 in taxes, assuming he has an average tax rate of just 24% during retirement. Now, let's assume Jack works with a Raymond Gorell Wealth Management advisor and utilizes NUA treatment on his company stock. With NUA treatment, the IRS will allow Jack to withdraw his company stock from the plan and deposit these shares into a brokerage account. Instead of $500,000, Jack will only pay tax on his cost basis of $50,000. Using the same average tax rate of 24%, he only pays $12,000 when he makes the distribution of $500,000 of his company stock. The $450,000 of appreciation above the cost basis is referred to as the net unrealized appreciation. The gain realized when the stock is eventually sold is subject to long-term capital gains rates. These rates are much more preferential to ordinary income rates and can be as low as 0%, but most commonly 15%. For our example, we will assume that Jack must pay 15% on average to sell his stock. This would generate a tax liability of $67,500. The total tax liability generated from utilizing NUA treatment is $89,500. Now let's remember, without NUA, the total estimated tax liability is at least $120,000. Initially, this is over $30,000 in tax savings. With efficient tax planning recommended by our team, it can potentially accumulate to be so much more. NUA treatment must be taken advantage of during a lump sum rollover out of your 401k. You really have three options on how to handle your company stock when rolling over your 401k. Your first, you can roll over your shares in kind to an IRA and pay taxes on the full amount as you decide to sell the shares and take distributions as needed. Your second, you can sell your company stock and roll over the cash into an IRA to reinvest in a diversified portfolio. As you take withdrawals, these will still be taxable at ordinary income rates. Your third, you can take advantage of NUA capabilities and save an abundance in taxes due to the preferential treatment of long-term capital gains rates. NUA treatment is available after one of 4 trigger points. These trigger points include separation from service, which is retirement, age 59 and a half, disability, and death. If a partial withdrawal is made, then you must complete the full and final distribution during that year, or wait until your next trigger point to take advantage of this special strategy. Now let's review some important considerations when determining if and how NUA treatment should be taken. Net unrealized appreciation makes the most sense for your lowest cost basis shares. If you own shares of stock with a low cost basis, do not sell them while they're still in your 401k plan. This would then reset your basis in these shares. Past stock splits actually lower your basis. For those of you that own shares that have previously split, this will create ample opportunity to take advantage of this strategy. And your company's stock must transfer in kind to a brokerage account. After the shares have been transferred, then you can sell the stock for diversification and cash flow purposes. Net unrealized appreciation is a very complex and delicate strategy to implement. Everyone's financial picture looks a little different. Here at Raymond Gorell, we can help people like you make the right choices to avoid common pitfalls and help maximize the tax savings available to you and your family. To contact our team, feel free to give us a call, send us an email, or visit our website. Thanks for watching, and we look forward to hearing from you soon.